Welcome back to Investing Talk Podcast.
Today we're looking at American Bitcoin.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone tracking crypto equities lately, American Bitcoin has been, well, impossible to ignore.
Impossible to ignore, but for all the wrong reasons.
Exactly. We really have to start with the chart because it tells a story of just absolute panic.
It's not just volatile, it's catastrophic. We're talking about a stock that saw this extreme, just stomach-churning pullback.
A staggering 80% decline.
80%. From its September highs around, what, $14.65?
All the way down to current levels, which are hovering near $2.42. For investors caught in that, it was just a brutal, shocking experience.
And the most dramatic part of that move was that massive single-day collapse we saw right at the start of December.
The stock just suddenly shed 50% of its value in one session.
When you see a drop like that, the immediate assumption is the company is fundamentally collapsing.
Right, you think maybe they lost a major contract or just missed earnings by a mile?
But here's the crucial element that we really need to define. That 50% drop, it was largely a liquidity event.
It was technical in nature.
Not related to the business suddenly deteriorating.
Not at all. A large supply of shares, which were previously locked up from a pre-merger private placement, they all just suddenly became available to trade on December 2nd.
And that's the key difference.
It is. When a massive supply like that hits an illiquid stock, especially one that's run up so fast, it just creates a vacuum.
And then the panic sellers jump in, the algorithms pile on.
And the price collapse becomes, self-fulfilling. It was just supply and demand mechanics driving the price, completely detached from the company's actual performance.
And when you do pull back from that chart panic and you pivot to the actual fundamentals, the contrast it's really astonishing.
A failing business would not have reported the Q3 2025 results they just did.
They didn't just report strength. They reported an explosive acceleration.
Revenue hit $64.2 million for the quarter.
Which is a massive 451% year-over-year expansion.
Yeah.
That shows some really robust operational scaling.
And the best part, that wasn't just, top-line noise.
No, they swung decisively to profitability. They reported $3.5 million in net income.
For a company in a high-growth, high-capex industry, moving from a loss to a solid profit is a critical milestone.
One that the market completely ignored during the panic.
And we can see the quality in their margins, too. A very solid 56% gross margin for Q3.
So that's not sloppy growth. That shows they're efficient, which keeps them right up there with the top-tier mining players.
Okay, so let's look at what is arguably the single most reassuring factor right now, the balance sheet.
After an 80% stock drop, you want to know if the company can survive, right? And American Bitcoin's financial health is what I would call fortress-like.
Absolutely. They're holding $92.4 million in cash and short-term investments. Total assets are at $1.11 billion.
But the real game changer in this sector is the debt.
Virtually debt-free. They only show $4.9 million in net debt. That lack of leverage is a massive, massive competitive advantage.
It changes everything. Why? Because so many of these pure-play miners, they finance their expansion with huge debt.
Meaning they're forced to sell the Bitcoin they mine, sometimes immediately, just to service those obligations.
Just to keep the lights on?
American Bitcoin is in a completely different class. Their current ratio is 3.04x.
Which is really high for this sector. It signals extraordinary financial stability.
They have no operational need to panic sell their treasury just to stay solvent.
Okay, so that low leverage is remarkable. But it's not just about what they don't have. It's about what that freedom lets them do.
And that leads us directly to their core competitive moat.
It's this dual strategy, which is fascinating.
Right. They operate efficient mining sites, which generate cash flow, but they combine that with an aggressive, strategic Bitcoin treasury accumulation model.
So they're insulating themselves from those forced seller dynamics you just mentioned.
Exactly. It's like adopting the Michael Saylor corporate playbook, but they've built the cash flow engine, the mining, to fund the purchases internally.
So they aren't relying on debt or diluting shareholders to grow their Bitcoin stash.
And their mining efficiency is what makes it all work. That partnership with Hut 8's data centers means their cost of mining is exceptionally low.
But 50% of the revenue per Bitcoin, right?
Roughly, yes. And that cost advantage is everything when mining difficulty keeps rising. It means they stay profitable even if Bitcoin's price stalls.
while their high-cost peers start bleeding cash.
Yeah.
And their hash rate is strong too, right? Around 24 exahashing.
Yeah, that puts them firmly in the top tier of global mining operations.
But for you, the investor, looking past all the noise,
Uh,
there's one metric management really wants you to focus on.
and that is Satoshis per share, or SPS.
Let's dedicate a minute to this because it's a brilliant way to measure how aligned management is with shareholders.
It is. SPS is a metric that tracks the company's total Bitcoin ownership on a per-share basis.
So it forces management to care about two things: maximizing the Bitcoin they hold.
And minimizing share dilution.
That alignment is so crucial. It shifts the focus away from volatile short-term revenue and toward the long-term appreciation of the asset they're holding.
It's a measure of capital allocation effectiveness, and the numbers show this strategy is in full gear.
I saw this. The SPS metric grew a staggering 57% in just 52 days.
It jumped from 275 Satoshis per share in September to 432 by early November.
That 57% growth rate, I mean. When their peers are selling just to survive, that tells a completely different story.
It confirms they're using cash flow to aggressively acquire more Bitcoin, especially on dips. They just added 363 Bitcoin when the price was down 35%.
That's a disciplined, systematic buy-the-dip strategy.
After a crash like this, investors always look for signals of insider conviction, right?
If the people running the company are selling, why should you buy?
Well, the structure provides some assurance here. Over 80% of the ownership is held by strategic partners and the founders.
And to address the public anxiety, Eric Trump came out and publicly reaffirmed he is not selling his shares.
Right, framing that December collapse as a clear generational buying opportunity.
Is that just skillful PR after a disaster, though?
I think it's both, but the fact that they have a debt-free balance sheet gives that statement real teeth.
So they have the financial freedom to ride out the volatility and hold on.
Exactly. Let's shift now from the fundamentals to the technical setup, because that collapse has created a really extreme chart pattern.
It's severely oversold. I mean, textbook severely oversold.
We're talking more than 50% below its 50-day moving average.
For technical traders, that kind of extreme divergence often precedes a sharp mean reversion rally.
A snapback, yeah. And we saw the immediate reaction to that. The stock stabilized and bounced a remarkable 40% from its panic low of $1.75.
Back up to 242 within days. That high volume during the bounce suggests that capitulation selling might be exhausted.
And that new institutional money, seeing the fundamental disconnect, may be entering.
That bounce is also getting a lift from some powerful macro tailwinds, too.
The Federal Reserve is finally signaling a pivot.
That dovish tilt is paramount. The market is now pricing in an 85% probability of a December rate cut.
And an easing monetary environment is universally supportive of high beta assets, which definitely includes Bitcoin and crypto stocks.
That macro shift is also coinciding with a dramatic reversal in institutional capital flows.
For months, Bitcoin ETFs were seeing massive outflows, right? Around 4.35 billion.
And that trend just flipped dramatically. We saw 370 million in net inflows on December 2nd alone.
The very same day the stock crashed. That shows institutions saw the price decline as a buying moment.
And even Vanguard, the firm that famously avoided crypto, they recently lifted their crypto investment ban.
These are powerful structural signals that large conservative pools of capital are preparing to re-enter the space.
Now, we have to address the risks, because nothing with this much volatility comes without some serious danger.
The primary risk, of course, is Bitcoin's price volatility.
This stock has a high beta, sitting at 3.55. What does that mean in practical terms for the listener?
It means if Bitcoin coughs, this stock catches pneumonia 3.5 times faster.
So if Bitcoin has another 30% drop, this stock is mathematically wired to decline much, much more rapidly.
This is not a low volatility holding.
Then there's the lingering issue of the lockup. While the December 2nd shock is done, the next major lockup expiration is scheduled for March 6, 2026.
And that includes the founder family's shares.
So that date creates a potential psychological pressure point.
It does. Even if insiders hold, the possibility of that supply hitting the market means the stock will likely trade at a discount leading up to that date. It's a headwind we can't ignore.
And this leads us to the valuation paradox, which is maybe the most unbelievable part of this whole story.
If we calculate the company's net asset value, or NAV, based purely on its Bitcoin holdings,
which is currently 4,367 BTC.
The stock is trading at an extreme, frankly absurd discount. It's at only about 0.6% of its NAV.
0.6%. That sounds too insane to be true. What justifies that kind of discount?
The market is valuing the stock based on its liquidity profile and its perceived risk, not its assets.
So it's a huge volatility discount.
Exactly. It's
Yeah.
not being valued rationally based on its treasury or its cash flow. And then, of course, there are operational risks, rising mining difficulty, energy costs.
Those could narrow that superior 56% margin.
Right. But despite all those risks, the volatility, the lockup, the discount, when you weigh the technicals against the fundamental strength, the risk-reward profile here looks highly asymmetric.
This all ties back to the long-term forecast for Bitcoin itself. Most analysts are projecting a range of, $150,000 to $200,000 by 2026?
If you believe in that macro outcome, the setup here becomes far more compelling.
And we can connect that forecast directly back to the stock through its own metric, SPS.
Exactly. If Bitcoin hits the midpoint, say 160,000, and American Bitcoin keeps growing its SPS at 40 to 50% annually, that's the driver.
And then you just factor in a modest market re-rating.
If the stock simply moves from its absurd 0.6% of NAV up to a still discounted 2.5%, the upside is enormous.
Under that base case, a target range over the next 24 months stretches conservatively from $24 to $32.
That relies on the market eventually valuing the underlying assets, not just focusing on the next lockup date.
So the final thought here is that the December stock collapse was a clear case of market panic.
A panic driven by a technical liquidity event that temporarily blinded the street to the company's improving balance sheet, profitable operations, and strategic accumulation model.
It has created a very clear contrarian accumulation opportunity for investors with high conviction in the long-term appreciation of Bitcoin itself.
If you found this discussion helpful, remember to subscribe, like, and comment to support Investing Talk podcast. We'll be tracking American Bitcoin and its fascinating SPS metric closely as we head into 2026.